Welcome back, everybody, to another deep dive.
Yeah.
Today, we are going to be taking a deep dive into the infamous Enron scandal.
Yeah, it's a big one.
It's huge.
And we've got this great case study that we're going to be pulling from.
Yes.
And I'm really interested to kind of unpack what
happened.
Like how did they go from being like this Wall Street darling to just
Absolutely. Yeah, I mean, they were this massive energy giant.
Right.
Like considered as the top of the top.
Like pioneers, right?
Pioneers, innovative.
Yeah.
And then it all just went
imploded.
Yeah. And they had reached a market cap of like $100 billion by 2000.
Yeah, that's insane.
And then within a year.
Oh, sorry. No, you go.
No, sorry, you go.
Okay, so within a year, their stock price plummets.
Yeah.
From $90 a share to less than $1.
It's crazy. It's just wild. So I'm really curious to get into this. So, I mean, where did it all start to go wrong?
Well, according to the case study,
a
lot of it really stemmed from a lack of truthfulness at the very top. Like the senior executives, they seemed way more concerned with appearances and their own compensation than with like the actual financial health of the company.
So it was all about keeping up appearances.
Yeah, basically prioritizing like short-term gains and just maintaining that facade of success.
Right. So even if things weren't actually going that great,
exactly,
they wanted to make it look like they were.
Keep everybody happy, keep the money flowing.
And the case study gives a pretty crazy example of this, right?
Yeah, tell me about it.
So, like the CEO selling off huge amounts of stock, while at the same time he was assuring employees that everything was fine.
Yeah. Red flag central. Right, like that raises huge ethical questions.
Oh, absolutely.
Like, what were the executives' duties to their employees and their shareholders?
Right, you have a responsibility to be truthful with the people that are
investing in you, working for you.
Yeah, exactly.
Totally.
So, and then on top of that, we've got Arthur Andersen.
Oh, yeah, Arthur Andersen.
Their auditor.
Right.
Also acting as their consultant.
Oh, that's a big one.
That seems like a conflict of interest.
Yeah, I mean, it's a huge conflict of interest.
Yeah.
How do you objectively audit a company?
Right.
When you're also making money from consulting for them.
Right, exactly.
Like, are you really going to be as tough on them as you need to be?
Right.
If you're worried about losing that consulting contract,
exactly.
you know?
Yeah, it just doesn't seem right.
So I think,
yeah,
that's a great question for our listeners to think about.
Just ponder.
Could this dual role
have contributed to that lack of oversight that allowed the scandal to grow?
And the case study actually brings up some research that shows that the shredding of Enron-related documents by Andersen employees had this huge negative impact. Not just on Andersen's reputation, but on the market value of their other clients, too.
Wow.
So it wasn't just about Enron. It was like this ripple effect.
Yeah, and it just makes you wonder, like, what were they so desperate to hide?
Right.
You know, that they would risk damaging the market value of all these other clients.
Right. So it seems like protecting themselves took priority.
Took precedence over their responsibility to the public and their other clients.
It's interesting because this whole thing kind of reminds me of...
Oh, yeah. What?
That classic game theory scenario. The prisoner's dilemma. Oh, yeah, the prisoner's dilemma.
Yeah. Right? Do you remember how that worked?
Yeah.
Refresh my memory.
Okay, so basically, the prisoner's dilemma shows that when individuals act in their own self-interest, even if it means betraying others, it often leads to a worse outcome for everyone involved.
Right.
So they're all trying to protect themselves. But in the end, they all end up worse off.
So how does that relate to Enron and Arthur Andersen?
So Enron's executives, they were focused on enriching themselves, even if it meant manipulating the company's financials. And then you've got Andersen facing potential legal trouble. And they chose to shred documents to protect themselves.
Even though that hurt other people.
Exactly. And you could even argue that the regulators who could have intervened earlier, maybe they were more concerned with their own reputations or their political careers.
Interesting.
So each party kind of prioritized their own interests.
Right.
And it led to this collective failure that had these huge consequences.
Yeah, it's like this perfect storm of bad decisions.
Yeah.
And it's interesting how, like you said, the case study really highlights how individual choices can contribute to this much larger problem.
Yeah.
So the case study also gets into like these accounting tricks that Enron used to kind of like inflate their apparent success.
Also make themselves look better than they were.
Yeah. Yeah.
Right.
So what kind of stuff were they doing?
Well, one of the methods they used was mark-to-market accounting.
Mark-to-market?
Yeah. And this basically allowed them to book their projected future profits as current revenue.
Okay. I'm not an accountant, so explain that to me.
Okay, so imagine you sign a contract to deliver energy, right?
Okay.
For the next, 20 years.
Yeah, okay.
Instead of recognizing that revenue gradually over the life of the contract, they would claim all the potential profit.
Wow. Up front.
So it's all projected. It's not necessarily going to happen.
It's all based on oh, this is going to be amazing.
Oh, so it's like creating this illusion.
Yeah.
Massive success.
Immediate success.
Immediately.
Yeah.
That sounds incredibly misleading.
It was definitely a way to inflate their earnings and attract investors.
Yeah.
But it wasn't built on actual performance.
Right, yeah.
It was speculation.
Yeah, okay, so that's mark to market.
Yeah.
But what about those special purpose entities?
Ah, yes, the SPEs.
Those sound shady.
Right. These were these complex financial structures that they used to hide debt.
And risky assets off of their balance sheet.
So they're basically creating these...
Yeah, they're creating these shell companies.
Shell companies to make their...
To make their financials look way healthier than they actually were.
So they're basically playing...
Yeah, it's like a...
shell game.
A shell game, exactly.
With their finances.
Hoping no one would notice.
Hoping no one would notice.
A real picture.
It's wild.
And the thing is... These tactics... While they were technically within... the accounting rules at the time, they raised these serious ethical questions about transparency and intent.
Right, because it's like,
okay, you're following the letter of the law.
Yeah.
But are you really acting in an ethical way?
Right, so it's that distinction.
Exactly, it's an important distinction.
Yeah, super important.
Yeah.
Especially in business.
Absolutely. And
where profit's involved.
Enron's story.
Yeah.
Is a perfect example of how those ethical lapses can have these devastating consequences.
Absolutely. So we'll take a quick break.
Okay.
And we'll be right back.
Sounds good.
Okay, so obviously these accounting gimmicks couldn't disguise the reality forever.
Nope, definitely not.
So when did it all finally come crashing down?
Well, Enron filed for bankruptcy in December 2001.
Wow, and that sent shockwaves through, not just the business world. Right?
Oh, absolutely. This wasn't just a Wall Street story. The impact was felt far beyond that.
Yeah, because you think about all the employees.
Yeah, thousands of employees.
Who lost their jobs.
Yeah, and not just their jobs, but their retirement savings.
Right, which were tied up in...
Enron stock.
Yeah. Yeah, that's devastating.
Oh, absolutely. It was a huge blow to a lot of people.
And the case study actually highlights this survey by the Pew Research Center.
Okay.
That was done right after the scandal broke. And it showed that a majority of Americans viewed Enron as a symptom of a much larger problem.
So it wasn't just Enron was bad.
Right. It was a sign of something.
Yeah, like a symptom.
Yeah, that was...
something bigger.
The whole system.
Yeah.
So what were people's main concerns?
Well, the survey showed that people were just really disillusioned with corporate America. They saw Enron as a symbol of unchecked greed and a lack of accountability. Yeah. And this led to a lot of calls for stricter regulations.
So did anything actually change?
Yeah, actually, all these calls for reform led to some pretty significant changes. In 2002, Congress passed the Sarbanes-Oxley Act.
Sarbanes-Oxley, I've heard of that.
Yeah, and that was directly aimed at preventing future Enrons.
So what did it do?
Sarbanes-Oxley, that was a huge piece of legislation. It really overhauled accounting regulations, and corporate governance.
So it's like a whole bunch of rules to try to prevent this from happening again.
It strengthened auditor independence.
Okay.
It mandated that CEOs and CFOs had to personally certify their financial statements.
So they're putting their name on the line?
Exactly. And it also established this new oversight board for the accounting industry.
So more oversight, more accountability.
Yeah.
It sounds like they really took...
Yeah, they really tried to address the issue.
So Enron's collapse, as bad as it was.
Yeah, I mean, it was terrible.
Yeah, it led to something good.
Right. It's like a classic example of how a crisis can lead to positive change.
Right. So it kind of forced everyone.
Exactly. They had to reassess.
Yeah.
And hopefully it made the system more transparent and resilient.
Yeah. So what about Arthur Andersen?
Oh, yeah. What happened to them?
What happened to Enron's auditor?
Well, what were the consequences for them?
Arthur Andersen was actually found guilty of obstruction of justice.
Wow.
For shredding all those documents.
They got in trouble.
Yeah, big time.
For trying to cover things up.
Right.
It's crazy.
And this verdict just had this devastating impact on them.
Yeah, I bet.
They were one of the big 5 accounting firms at the time.
Yeah.
And they lost clients. They faced all these lawsuits.
Yeah.
And ultimately, they were forced to surrender their accounting licenses. And they basically ceased operations.
So they were gone?
They were out of business.
Wow.
It's remarkable.
It is.
How quickly they went from being an industry leader to just a cautionary tale.
Wow. So what about the individuals at the heart of this? Like Kenneth Lay, Andrew Fastow. Right.
What happened to them?
So they faced some pretty serious legal consequences.
Okay.
Lay, he was the CEO.
Yeah.
He was found guilty on 6 counts of fraud and conspiracy.
Wow.
But he actually passed away before sentencing.
Okay, and what about Fastow?
Fastow?
The CFO who, like...
Yeah, the one who designed...
Yeah, those SPEs.
Those elaborate SDEs.
Yeah.
Yeah, so he actually pleaded guilty to wire and securities fraud.
Yeah.
And he agreed to cooperate with the government in exchange for a reduced sentence.
So he got a deal.
Yeah. He ended up serving 6 years in prison. And he became a key witness in the trials of other Enron execs.
So it seems like there was a sense of accountability.
Yeah, definitely.
Not just for the corporation.
Right. They were held personally responsible.
Yeah, because I mean, for
their actions.
Sometimes it feels like corporations can kind of hide behind.
Yeah, it's easy to kind of...
this veil.
Yeah, just blame the corporation.
And just say, oh, well, it was the company, not the people.
Right, but in this case...
But these prosecutions really made it clear that those executives...
They couldn't hide behind the corporate veil.
Oh, right. You're
responsible for your actions.
Accountable for your own choices.
It's a powerful message.
Yeah.
That ethical lapses have real-world consequences.
Yeah, and the case study really frames Enron's downfall as this failure on so many levels. Right?
Yeah, like it's so multifaceted.
It's not just one thing.
It's not just like, oh, they were greedy.
Yeah, it's not just individual greed.
Right.
It's corporate culture.
Absolutely.
Regulatory oversight.
Definitely failures and oversight.
And even like societal pressures.
And even societal pressure. Yeah.
It's wild.
Yeah, it's this complex web of factors.
So we've got individuals who are making unethical choices.
Right.
But they're also operating within a system.
Yeah, a system that kind of incentivizes those choices in a lot of ways.
Yeah.
So it's like this vicious cycle.
Yeah.
You know?
Yeah, because you think about like Wall Street.
Yeah, that whole culture.
That culture of...
that rewards aggressive accounting.
Yeah.
That rewards that relentless pursuit of growth.
And it seems like everyone was caught up in the hype.
Yeah.
Like the analysts, investors.
The media. Everyone was like, Enron's amazing.
Enron's the future.
Yeah, and they were all kind of blinded by it.
Yeah.
And no one was really...
Yeah, no one stopped to...
questioning the sustainability.
Yeah, or see those warning signs.
Of their model.
It's like, when something's too good to be true.
Right. It probably is.
It probably is.
Enron is a great example of that.
Yeah, it really highlights the dangers of groupthink, right?
Absolutely. You can't just blindly follow the crowd.
You got to maintain a healthy dose of skepticism.
Especially when it comes to finances.
Right. Don't put all your eggs in one basket.
Don't believe the hype.
So I think Enron's story really reminds us that even these seemingly invincible giants,
even the biggest companies can be built on shaky foundations.
Right. It can all crumble.
Absolutely. Yeah, and it's a reminder that we all have a responsibility to be critical thinkers.
To ask questions.
To question assumptions.
Yeah.
To hold ourselves and our leaders accountable.
Yeah, because, I mean, at the end of the day, it's all about making sure this doesn't happen again.
That's right.
We've really been digging into, like, the nitty-gritty details of this whole Enron mess. But I'm curious about the bigger picture now.
Right.
Like, what can we learn from this?
Well, I think Enron really serves as this powerful reminder that unchecked greed and a lack of ethical leadership can have these far-reaching consequences. I mean, it really exposed the vulnerabilities of our financial system.
Totally.
And highlighted the need for, like, greater transparency and accountability.
Yeah, because it's like they were able to get away with this for so long.
Yeah.
Because it wasn't enough.
Yeah, not enough oversight.
Oversight, right.
And they were prioritizing those short-term profits.
Right, just trying to keep up that facade.
Long-term sustainability.
Yeah.
They sacrificed the foundation of their business.
For that illusion of success.
Exactly.
Yeah.
Classic case of hubris.
Hubris, yeah.
Thinking they were invincible, above the rules.
Right. Like they could bend reality.
Yeah.
But reality always catches up.
It always does.
And the case study also makes this point.
Okay.
That Enron wasn't just a wake-up call for the business world, but for society as a whole.
It kind of forced us to confront some uncomfortable truths.
Yeah, like what?
About our values, our priorities. I mean, it challenged this notion that the pursuit of profit justifies any means.
Like the ends justify the means.
Right, exactly.
And are we really okay with that?
Yeah, it raised questions about the role of government regulation, the responsibility of corporate boards, the ethical obligations of individuals within organizations.
So it's like everybody has a part to play.
Exactly.
So we've got Sarbanes-Oxley now, which is supposed to
prevent future Enrons.
Yeah.
Right.
But it feels like the real challenge.
Yeah, the real challenge is changing the culture.
Yeah, like the underlying culture.
Yeah, the culture that allowed this to happen.
Because rules are only as good as the people who follow them.
Exactly. Laws and regulations, they provide a framework.
Yeah.
But they can't eliminate greed.
Right.
Or ambition.
Right, human nature.
Right, so it comes down to
individuals making ethical choices.
Even when it's hard.
Even when there's pressure to do otherwise.
So at the end of the day, the case study really stresses individual responsibility.
Individual responsibility,
Like we all have a role to play.
We all have a role to play.
In making sure that business is ethical.
Yeah, and promoting
a more ethical and sustainable business environment.
So what can our listeners do?
Well, I think it starts with asking questions.
Asking questions.
Demanding transparency. Holding our leaders accountable.
Right, not just blindly trusting.
Exactly.
So it's like, support companies that align with your values.
Absolutely.
Speak out against things.
Yeah, if you see something
shady
that seems unethical, say something.
Don't be afraid to use your voice.
Absolutely, I think.
So Enron's legacy.
Yeah.
It's complicated, right?
It is complicated.
It's a reminder of how bad things can get.
Yeah.
But it also sparked this movement for change.
For greater transparency and accountability.
Yeah, and that's a good thing.
Yeah, and those are lessons that are still relevant today.
Absolutely.
As we navigate this increasingly complex global economy.
So what's the one thing we want our listeners to take away?
The one big takeaway.
From this whole Enron deep dive?
I think it's this.
Yeah.
Even the most successful looking companies can be built on lies.
Right. Don't be fooled.
So be critical, do your due diligence.
Yeah.
Be skeptical.
Especially when it comes to money.
Especially when it comes to money.
Absolutely. And I think the other big takeaway is that ethical behavior. It's not optional.
It's not a nice to have.
It's essential.
It's fundamental.
Yeah, for a just and sustainable society.
It's something we all have to work towards.
We all have a part to play.
Yep.
Yeah. So let's learn from Enron's mistakes.
Let's not repeat history.
Let's make sure that integrity and accountability.
Integrity and accountability
are the norm.
That's what we got to strive for.
Not the exception.
Not the exception.
All right. Well, that's going to wrap it up for today's deep dive.
Yeah.
Thanks for joining us.
Thanks for having me.
We'll see you next time.
See you later.